Hi, welcome back to Accounting and Tax Helpdesk. I'm Nima here with Haas, my business partner. I'm going to talk about tax, and Haas is going to talk about the CFO services. We're going to jump into talk about the tax strategies and what kind of business entity you need to create to start your business. If you heard the first episode, we talked about ourselves, we introduced ourselves, and you already know. And then I hope you keep your feeling that how well you know us. But let's talk about tax today. And today I'm going to talk about what kind of entity you need to create when you start your business. That's the question I always get, and there is not one answer. But I'm trying to explain it as much as I can, make it simple, not make it complicated. I'm planning to talk about the C corporation, start a conversation about the business entity. So let's talk about the C corporation. I will try to explain different scenarios how the C corporation would be. And Haas, what are we going to talk about today?
So it's the end of the year, and most of the people, they're asking me, how can I budget for my next year? And the first thing I'm telling them, manage your cash. Let's budget your cash.
No.
So I'm gonna talk about the cash management and how they can forecast their cash at the beginning of the year to the rest of the year.
So what type of entity I should create? Do I need to have a C corporation? Should I have an LLC, S corporation? What should I do? That's the question I always get. And which one is more advantage or over the other ones?
So, question for you.
Sure.
People are asking me, and I usually come to your office and ask you, do they need to have an entity or a business entity to deduct for their taxes, or what's the best way to deduct their expenses?
I always think about that question like a relationship or marriage. If you you can live with somebody, you can have kids, you can go to the movies without getting married, or you can get married. So technically, you don't need to create an entity to be able to deduct your expenses. You can just have self-employed and then not creating any entities. But the problem is you don't have any legal protection. So if you have some business ideas, you're not even sure what kind of business it is, it's the first year, it's going to have some expenses, don't create an entity. Like a relationship. If you want to, maybe it's not appropriate, but if you want to have a one night stand, you're not going to get married for one night stand. So you just don't need to create an entity if you're not sure what your business is. It's just going to be expensive, and you're not worried about any legal protection, because if your business is not started, so there is no legal protection. Nobody's going to come after you.
The other question people are asking, what's the best entity? What type of, is it LLC, S Corp, C Corp?
That's going to be it's not just a simple yes or no. It's different scenarios. It depends your situation that I'm trying to explain it here. It's not that complicated, but let's talk about it now. The first option is just have a C corporation. You have a corporation. What's the disadvantage of having a corporation, C corporation? It's like for first 4 or 5 years you're not making any income. It's just going to be expensive. But what's happened is you cannot deduct any of those expenses. You're not going to pay any taxes in the C corporation, but you don't take any advantage of write-offs. So if you're making a corporation that you don't expect producing any net income for first 2-3 years, forget about the C corporation. It's not going to, it doesn't help you to deduct your expenses in excess of your income. The second option is you're making money. Great. Let's get a lunch and get to know each other if you're making good money. Even if you don't, that's okay. I'm not all about money. But let's talk about that. You're making money, you have a C corporation. What's the problem? When you have a C corporation, you pay federal tax on the C corporation level. Right now it's 21% flat rate. Okay, you pay 21%. Somebody says, oh, if I have it personally, it's going to be maybe 30%. But it's not the case. You pay 21% on the C corp level, but then you want to take the money out, it's going to be considered as a dividend. That's why they call it double taxation. So you need to avoid the double taxation. Sometimes, even with the double taxation, it's beneficial to have a C corporation. Let's say 21% on the C corporation level, 20% dividend income. So that would be your taxes. But what your other option is, you have a LLC or S corporation, or all of those are pass-through entities. That all the income is going to be passing through you. So you're paying those taxes one time on the personal level. There is no double taxation. And then right now there is a qualified business income deduction that is 20%. But it could be varies. It could be that you have different options, but most likely in a lot of cases you will be able to get benefit of those qualified business deduction. So in this case, if you're making money, C corporation might be a good idea, but not the best idea. And then having a pass-through entity for sure is a better idea, because it's going to be avoid any double taxation. I forgot about talk about it. When there is a dividend income when you take the money out, there is additional tax, and you have to pay net investment tax on that additional money you take out. So C corporation, you're making money at this scenario might not be a good strategy. But sometimes C corporation, when you're making the money, is a good strategy. What is that scenario? It's when you're having a startup company and you're not planning to take the money out. You're planning to grow your business. The business grows and then you sell it later. That's a good strategy. In that time, you're making money and have a C corporation. The reason is when you take the money, you just don't pay taxes on the federal level. You don't take the money out, so you don't have a double taxation. And then when your business grows, you just sell your stocks, and then you just pay capital gain on sale of stocks. So in this scenario, C corporation is more beneficial when you have a business, you're planning to grow, you're not planning to take the money out, and you're planning to sell in the future. What is the other option? The other option, again, you have a C corporation, you pay yourself all of your profits. So this way you say, oh, I'm avoiding any double taxation. I'm just paying myself through the salaries. What is the disadvantage? First, sometimes you need to pay reasonable salaries, pay IRS guideline. You cannot just take at least zero out your income and say, okay, I'm just zero out my income and just paying one level of tax. That would not be the case. Sometimes IRS needs you to have a reasonable salaries and payment to yourself or any related parties.
What is this reasonable salary? You're asking.
Big question. So if you are, I don't know, a doctor, and if you pay yourself $1 million, okay, it's a reasonable salary. But if you are, let me just say accountant, so I don't want to offend anyone. If you're an accountant, if you pay $1 million, oh, maybe. But yeah, it should be reasonable. Don't pay yourself if you have a.
So IRS decide to be as vague as possible.
Yeah, very vague. You cannot zero out your profit just saying okay. Then what other option? Then you actually lose some benefits again. If you just pay yourself salaries, you may lose the option of get like qualified business income deduction again, because it's not a pass-through income, it's just a debited to salaries, and then you pay a lot of self-employment tax on that salaries. So these are where options that you have a C corporation. In the future, I will get more details. Okay, what other options you have for the pass-through entity taxes, and how you can avoid all of the self-employment tax and then get more benefit of having a pass-through entity tax versus C corporation. In these last 4 scenarios, your options were having a C corporation versus not having a C corporation. There were 2 scenarios. There were C corporation were beneficial. Actually, one scenario. That's the one that your business is growing. That would be a section that, okay, your business is growing, you're not planning to take the money out, just create a C corp. But there is one scenario that you must not create a C corporation. And then when you have appreciated property, you don't put appreciated property in C corporation. It's a no-no. Your property is going to grow in the value. When you sell it, it's going to be a double taxation. It's going to be a disaster. You're not going to be able to take advantage of a lot of benefits of getting a loan from a outside party and have a basis. So if you have appreciated properties, forget about the C corporation. In the next episode, I will go more details what the benefits of having a pass-through entities and any other entities. But after we talk about the C corp in the future episode, I'm planning to talk about the more other options you have other than C corporation, and then what entity type would be the best suit for you. If you have any question about anything I talked today, just please send me a DM, ask me questions, and I would be happy to answer those questions in the future podcast. All right, Haas, so that's enough about C corporation and the tax that you hated before, like you said, but let's talk about the CFO services.
Thank you, Nima. I learned a lot. I still hate taxes, but yeah, you do taxes, I do my part.
Yeah.
So in this episode, at the end of the year, people usually trying to budget for their year, but they don't know how to manage the budget. I'm gonna deep dive into mainly the cash budgeting. So people usually ask me, how can I manage my cash if I don't know what's my bill or how much money I'm gonna get from my customers? So I'm gonna deep dive on that cash management. So my first advice to all of my clients is try to create a 13 weeks cash flow. That means basically you're gonna forecast your cash flow for the next 13 weeks. It's the next season. You plan for the next season. You're gonna basically get your historical data. You know you have your credit card payments. You know you have your car payments. You know you have your utility bills, all your recurring bills that you have, and you know the due date for those bills by now. So you usually plan for those and create an Excel sheet, Google sheet, whatever it suits you. Just put those on the dates of the calendar. And then you have your AR. Basically what I advise my clients, let's say you have $1 million in your account receivable, we call it AR as short. I put like 5-10% as a bad collection. So if you have a $1 million AR, I automatically deduct 100K, 10%, just because to be sure you are not get surprised if the customer doesn't pay you. If it pay you on time, great. If it doesn't pay you, at least budgeted for that lack of cash. Then based on your invoice due that you already issued, you're gonna plan your cash coming in, and you're gonna plan your cash coming out based on all the bills that we have, all the credit card, anything. And then the difference between these two numbers is your delta, is your cash management. It's easy to forecast, and then if you have excess of cash, you're gonna make a decision. Do I need to hire someone to help me out? Do I need to buy that equipment I always wanted, or do I need to get a distribution?
Or pay my accountant more.
Or pay your accountant more. That's a better option. So then we can plan for that. So again, at the end of the year, 2025 is coming up. We need to plan the cash for our customers. So as we start new year, we need to make sure we plan our cash accurately. One thing that people always forgot and usually hit them in March, April, and September is they never plan for their tax payments. And April 15 comes, they owe a massive amount to the IRS and they never plan for it. So at the beginning of the year, let's talk to your tax accountant, let's talk to Nima, project our taxes, how much gonna be my tax liability estimated, so we can budget for that, put it aside, so at April 15, when you have to cut the check to IRS, you don't get surprised. You already planned for it.
So just the question I get that I think you're expert in it. So the client always said, in this, it turns on the scenario. If they want to show they made the income, they'll say, I made a lot of income. How come I don't have any cash in my pockets? But I made $1 million. Like what are the scenarios that they think they made money but they don't have cash?
It's an excellent question. Something people are always confusing. when they issue the invoice to the customer, they think that's their cash, but that's your income. Yes, you have to recognize your income because you sell the product and you issue the invoice, but that money is not in your bank accounts in next 30 days or 40 days. The other thing is you borrow from the bank a loan to like SBA loan or something, and now you have to pay that loan. So the cash coming in, then you have to pay your first installment of the loan, then you don't have money. So the cash coming in is not your income. Your income is the AR. But that's why it's very important to people to be able to forecast their cash minimum for the 13 weeks to basically, if the revenue is high, where is the cash? We need to account for that. So in next episode, I plan to talk about something we call in the accounting world cash conversion cycle. So I'm going to have a deep dive conversation of what are the different part of this KPI that I always have my clients track, and I'm gonna basically dive into that in next episode in more detail for you. So thank you everyone for joining us again in this week. Nima talked about the C Corp and different advantage and disadvantage of C Corp had. I talked about the cash management and the cash flow. Thank you so much, it means the world to us. If you like, share, subscribe. If you have any question, drop us a comment, send us an email at helpdesk@alamircpas.com. We'll get to our question and answer them in this podcast very soon.